I'm Matt Horsley, Certified Financial Planner with Pure Financial Advisors. This is your question of the week. The question is, what is a stock and how does a stock work? Let's first go back to how companies raise capital. They can raise capital in one of two ways. They can either issue bonds, which is essentially taking loans out from individual investors, or they can issue stock. And essentially, by issuing stock, what a company is doing is they're giving up ownership, an ownership stake in their firm in exchange for the investors sharing the future profitability of that firm. So if you think about it this way, let's say that I was a small corporation, just a startup firm, maybe I was starting a restaurant, and I wanted to raise money via issuing stock. So if I wanted to raise, let's say, $500,000 to build my restaurant, I may have to give up 20, 30, 40, 50% of my ownership stake in the firm for someone to invest that money with me because it's such a risky venture. Now, let's take a company like Microsoft or Caterpillar or Coca-Cola. If they wanted to raise $500,000 from investors, they would have to give up a very, very small ownership percentage in that firm because they have such a long history of profitability and the expectations of large future growth and profitability in the future as well. So once a stock is initially issued, then it's traded on public exchanges. And then the stock during the course of a trading day, quite frankly, is worth whatever investors are willing to pay for it. It's all supply and demand that dictates the price of a stock once it's initially offered to the public. That's how a stock works. I'm Matt Horsley. That's your question of the week.